Hi everyone, welcome to today's session being hosted by Angel Broking. I am Pranav from Smallcase and today we have Mr. Chetan and Mr. Aman from Abacus Investment Advisors. In this session, Abacus will be discussing about their take on the market outlook and also give us a holistic idea about some of the key small cases they have designed on the platform. To give you a brief introduction about Abacus Investment Advisors, Abacus is an alpha-focused asset management firm set up in 2018 by Sunil Singhania. Sunil is a CA rank holder and a CFA charter holder and has a distinguished track record of over 2 decades in equity investments. Earlier, as CIO of equities for Reliance Mutual Fund, which is now Nippon India Mutual Fund, he played an instrumental role in building Reliance Mutual Fund into one of India's largest AMCs, overseeing approximately $11 billion of equity assets. Reliance Growth Mutual Fund, which is now Nippon India Growth Mutual Fund, which is being independently managed by him, has the unique distinction of having grown over 100 times in 21 years. Reliance Small Cap Mutual Fund, which is now Nippon India Small Cap Mutual Fund, was rated amongst the top mutual funds in its category. He is currently appointed on the IFRS Capital Markets Advisory Committee and the only member from India to be appointed for the same. He served on the global board of CFA Institute, USA, between 2013 to 2019, and as chairman of the investment committee between 2017 to 2019 of the CFA Institute, USA. Abacus is managing rupees 10,000 crores across AIF, PMS, and advisory platforms. So without further ado, I would request Mr. Aman from Abacus to take over from here.
Sure. Thanks, Pranav, and a good day to all the listeners and viewers. I'm Aman, and I'm the Senior Fund Manager at Abacus. Just to give you a brief before we start, I have almost been 15 years with Sunil at Reliance, and when he founded Abacus almost 4 years back, I moved along with him from Reliance, and I've been with the company since its inception. I'll broadly take you through the strategies that we follow at Abacus, the market outlook, and then we'll come specifically to the product offering that we're going to discuss today, which is the Build India portfolio. Coming to the investment philosophy, Abacus was founded with a vision to make it a niche boutique AMC and have strategies which are not similar or run-of-the-mill as compared to what other competitors in the street would be. So what differently we do versus others would be as follows. First and the foremost is that we believe in alpha generation and we don't believe in benchmark investing. Just because a stock is a certain weight in the index, most of the funds would say either go underweight or overweight that stock. We don't have that concept at Abacus. We will invest only if we find an investable idea where we feel we can make a return. We never do underweight or overweight investing at Abacus. And this is true to all the strategies that we follow here. We do only fundamental investing, no derivatives, no technicals, no charts, no momentum trading, no news-driven events, nothing. Pure bottom-up investment ideas, meet a company, make a clear investment case, and invest with a clear 3 to 4 years of investment horizon. We are aggressive and we are happy to be a contrarian investors. At the same time, we generate our own ideas. We have a large investment team of 13 people, and we read annual reports, we speak to market consultants, we speak to management, we speak to various people involved in the markets to generate our own ideas, and hence we are not completely dependent on the brokers to give ideas to us. If you go through a portfolio, you'll find at least 30 to 40% of stocks would be stocks where we are the first or the only institutional investor. And we are happy to be in that scheme because that gives me a first mover advantage. We are agile, flexible. If we go wrong, we are not shy to bite the bullet and get out of the holding and move money somewhere else. As I mentioned, the patient investors invest with a clear 3 to 4 years investment horizon. And this sixth and the last but very important point is that of risk-reward equation. We feel this is something which is core to any investment that we do. A great company need not necessarily be a great investment. It will become a great investment only if I buy it at the right price. And this is something that we very religiously follow. So while I'm not a value investor, I'm definitely a value conscious investor. But this what I mean is that I do mind paying a 70, 80, 90 P to a stock just because it is the market leader or the market favorite. If you're growing at 10, 20, 30%, I don't mind paying a 20, 30p, but I do mind paying a 70, 80p just because you're the market favorite. I'm not running a business. I'm running a fund. I'm making a financial investment. And hence, a great company also needs to be a great investment. And for that, the risk reward equation should be in my favor at the time of investing. And this is something which we believe to the core. So to follow this philosophy, we have made a very simple framework which we use at the time of investing, which we call as the NEAT framework. This is basically the factors that we consider at the time of investing in any company that we do. The MEET stands for M, which is the management. Clearly, this is the most important factor. This is the captain of the ship. By management, I just don't mean the quality of the management. It also revolves around the past track record of the management. We meet each and every management that we have invested into. There has been no investments where we have not managed management, and this is something which is very critical to us, because ultimately he is the one who has been driving the company for us, and unless and until the company delivers, stock is not going to deliver, and hence management to us is very critical. It's not just the quality of the management, but also what has been the corporate governance, how fair he has been to minority shareholders, what has been his past track record is something that we look for. E stands for earnings. This is equally critical as the management is. Our firm believes that if there is no earnings growth, it is very difficult for the stock to perform. So you might be a value, but if without any earnings trigger, then the value can become even deep value. So this is something which we very religiously follow. So most of the stocks, if not all, in your portfolio would be stocks where we have a very clear earnings growth visibility, and that is the reason why we have invested in that company. The other D stands for events or trends. At any given point of time, there could be some events in a stock. This could be events like, say, M&A, it could be stock split, it could be demerger trigger, it can be some news, some policy, it can be anything, but there has to be some event, there's some trigger in stock. Otherwise, it becomes me too stock in the portfolio or into the markets, right? So there has to be some trigger for investors to look at the stock and to get it re-rated, or for us to enjoy a price appreciation, and that is something that we follow. So we look for events, we look for triggers for a stock at the time of investing. T stands for timing. Here, very clearly, it is not trying to time the market. We don't even attempt to do that. Timing to me is the timings of the earnings trajectory for a company. Most of the corporates in India and even globally don't have a very linear earnings growth. It's always ups and downs over a period of time, right? So we would like to time the earnings recovery or the earnings acceleration of the market. There's no point owning a stock where the earnings growth is going to come after 2 years or 3 years. I'm a patient investor. I'm ready to be patient for 3, 6, 9 months, but not perpetually, right? So there has to be always some macro and micro events in the life of a corporate, and we would try to this in our stock picking rather than trying to time the market. So it's always specific to the company as far as the timing is go. And S stands for structural. It's a growing economy of India where we all know the under-penetration that we have in the scope of opportunity of growth. Lots of corporates, lots of sectors have. These are structural opportunities led by the demographic placement of India. And we would also like to participate in some of these opportunities. So hence S stands for the structural opportunities that we also see in the market, and we invest in them. So it's a combination of these factors that we look forward to at the time of investing. Now, the proof of the pudding lies in eating it, and how exactly we follow this MEET framework and how exactly we follow this strategy is something that I'm going to take you through over the next 5 minutes. So there are 3 buckets in market: large, mid, and small caps. I'll tell you as to what exactly we do in each of these buckets. The first one is the large caps. These are the top, say, 100, 150 companies, market leaders. We all know by the name, great businesses, great management, great franchises, and obviously they are the market favorites. But at the same time, they all trade most of the time at a very significant premium to what the peer group would be, just because they are the market leaders. Now, as I mentioned to you, we don't do benchmark investing, and hence, practically speaking, since I'm also a value conscious investor in my portfolios, rather than a leader, you will see a number 2, number 3, or number 4 player in the industry. We don't go down the drain, but we always feel that a number 2 or number 3 guy presents a better valuation and hence a better risk reward equation than just blindly buying the leader. For example, in banking, any large cap portfolio, see, they would have either HDFC Bank or the Kotak Bank. Nothing against them. They are great banks, great franchises, market leaders. But at 3 to 4 times book, I don't find valuation valuation comfort in these. And hence, I would prefer to have an ICICI Bank or an Axis Bank or an State Bank in my portfolio. Number 2, number 3 guy, equally good banks, equally good franchises, and aiming to be the leader. And hence, they are more aggressive. And it gives me an opportunity to not only have an earnings growth, but also a PE re-rating into the stock that I own. Similarly, in IT, most of the portfolio would not have a TCS or entry, but would have an Excel tag. It's not a rule that I will never own the leader. If my risk reward equation is favorable, why not? For example, in pharma, we have some farmers in our portfolio, which is India's largest pharma company and doing well. They started investing 6 months back and sorry, looks pretty interesting to us. Or say UPL, India's largest agrochemical company. We own it because it's a decent growth company, and just with 10 to 12 times forward multiple for FY24, it's a steal valuation, and hence my risk reward equation is very favorable. So I will invest into a leader only if my risk reward equation is favorable. Else, practically speaking, you will find a number 2, number 3, or number 4 guy into my portfolio as far as the large caps are concerned. Coming to mid caps, this is what the broader market in India would be, and we are known for our mid cap investing. The philosophy we follow here is pretty simple. You would be a smaller company, but within the space of your operations, you should be a known player, and there should be some uniqueness in your business model or something in you for me to look at you besides just valuation. So we'll never buy a mid cap just for valuation. There has to be some trigger, there has to be some reason, some investment rationale for me to look at this company. And you need to be a known sizable player, at least in the size of operation that you operate into. So the kind of mid-cap investing you will see in our portfolio will be companies say like ISEC, which is India's largest non-discount broking house, or say a company like Rupa, which is a number 3 player in the India segment after Jockey, or say a company like Muthoot Finance, a very classic example. In the large banking space, there's a small sub-segment called gold loans. But within that gold loans, Muthoot is the market leader. It is India's largest gold loan lending company. And that is what we have in the portfolio. Or say a company like Hyderabad Industries Hill, which is India's largest roofing company. Or say Questcorp, India's largest staffing company. Radio Chetan, which is India's largest local liquor company. Balrampur Chini, which is India's largest sugar company. So these are the kind of companies that we have, known companies. But the reason for me to own them or the timing of an investment is something which is different, which is what we strive to achieve. And we would like to be ahead of the others and invest into these companies so that we get the first move advantage. So this is typically the mid-cap investing that we do. The third bucket is the small cap. This is the smaller company in the market. And the general perception here is that small caps are more risky. We have a different view. We don't feel small caps are necessarily risky because effectively what is risk? Risk is doing something that you don't know. If you're getting into a stock with a very clear view as to what you're getting into, and if your risk reward equation is in place, then you're not taking an undue risk. Yeah, but definitely that these are smaller companies. These are more volatile earnings. They have less liquidity, and hence the price fluctuation is much higher than compared to a large cap, and hence I'm taking a slightly indirect higher risk, and my return expectation also from small caps is much higher. So what I look for a small cap company would be a clear multi-bagger kind of a thing where I can make a potential 2 to 3x return over a 3 to 4 year period. And how do we do that? We do that by doing some thematic investing. We do that by sometimes banking on the promoters. When you meet a management, you feel that this management has the drive, this management has the capability. The current P&L or balance sheet might not justify, but still you want to take a bet on the promoter, which we do that. We look at niche business models, companies with great IP, and this is what my intention would be. I'll be a patient investor, but when an investment call goes right on a small cap, I expect a multi-bagger 2 to 3x return from this. The kind of stocks that we have done small cap investing and has been pretty successful for us to become like Gentle Stainless, a classic turnaround. Few years back, the company was in CDR with debt restructuring on the books. Next year, hopefully, the company is going to be debt free. So that is the kind of transformation the company has seen. Or a company like BSE, unique number 2 player in the duopoly industry, or say a company like Mastic, a 40-year-old IT company headed nowhere. Till a few years back, the founders thought that it's time they take a step back and they inducted a professional CEO and a CFO, and there was a complete transformation in the business. And we own almost what 6% of the company now. Or a company like Saregama, which is a unique business model. It has a unique library of the old Kishore Kumar Lata Mangeshkar songs, which nobody else in India has it. And the piracy tailwind, which was hurting this industry, the piracy headwind, which was hurting this industry, today has become a tailwind, because now, due to a platform like an Apple Music or a Savan or a Ghana, by looking at ads on YouTube, you're indirectly started paying Saregam, and he's been able to monetize this library. So this would be the kind of small cap investing that we do: unique businesses, unique companies, thematic investment with a very clear risk reward equation in place. This has been our past performance. We run broadly two broad strategies on the AIF platform. One is an all cap strategy, which is almost 3+ years of track record now. And in this period, we would have almost doubled the NAV, which is almost 2x of what the market returns would be. And we also have a dedicated mid and small cap strategy, which is 2.5 years old now. In this period, we have almost tripled the NAV, which is also almost 3x what the market returns were. So it's not just the performance which has been in the top quartile, it is also that the performance has been pretty consistent. There have been 4 phases in the market, as you can see on the screen. Pre-COVID, then there was a COVID fall, which was March 20 to July of 20. Then there's a gradual recovery, and then the last 12 to 18 months, the markets have been great, and we have been taking the benefits of the economic recovery. If you've seen all these 4 phases, both the funds have performed better than the markets, and during the COVID crisis, we felt along with the market. This is what we strive for. In a down market, in a falling market, don't fall significantly more than the market, and in a rising market, generate an alpha eventually. And this is what the plan we have for. To be a consistent performer across market sectors is what we strive for. So that's broadly on what Abacus is, and this is in a nutshell as to why one should look at us as an AMC. We have a very unique positioning in the market. We are opportunistic investors, consistent performers. We are committed to what we do, and we have a very consistent performance track record, backed by an experienced team of 13-member team headed by Sunil and followed by me and my colleague Chetan, who is going to present the fund in some time. So before we start the fund, a quick look on the broad market outlook. This is something which I believe you all would be eagerly looking forward to. It's been volatile times in the market, especially the recent few months post the Ukraine crisis that we have seen, and the recent interest rates and the inflation worries that we have. So what is the concerns today? The concerns today is mainly inflation, which is leading to higher interest rates. So while we have seen only one round of rate hikes, if you see the charts below, both the bond yields in India as well as in US have already risen, and they're already factoring a series of interest rate hikes that's going to happen. If you look at the US markets, the markets they have already discounted that there's going to be at least 3 to 4 25 bips rate hikes over the next 12 months. And a similar expectation is there in India, that there's going to be at least 1 to 2 25 bips of rate hike in India also. Because of the supply disruptions, because of the COVID impact, because of China sanctions, because of the Russia-Ukraine crisis, commodity prices across the board has gone up, whether it is steel, cement, crude, freight, shipping, power. And this is what has indirectly fueled the inflation, which we see on the top 2 charts, where the US inflation today is running around 7%, and the Indian inflation is also somewhere close to that mark. And this is what the worry is, and we feel that the worst of the inflation is probably in the price. It's not going to be a magic wand that from next month onwards or from next quarter onwards, things will be back to normal. It's going to take 3 to 6 months before the inflation worry subsides and before the inflation gets back to normalized level. During this phase, there are going to be rate hikes, there are going to be central bank interventions, there are going to be government policies and action to control this inflation. Because of this, there can be near-term volatility in the market over the next 3 to 6 months. Post which we feel that the inflation should normalize because the demand is there at a certain price. If the price goes up 1x, 2x, 10, 20, 30, 40%, the demand also is going to get impacted, right? So far the demand has been good. Post lockdown, there's lots of pent-up demand that we are seeing in India as well as globally, but this is all coming at a price, right? So in the next 3 to 6 months, inflation will also get the benefit of the base effect. So once the base effect kicks in, central banks won't be in that much pressure to raise hikes, and that is something which is good for the markets. So net in the near term, there is going to be rate hike, but that's not what is going to surprise the markets. Markets are already aware of this, and we don't feel it's going to create any major significant volatility. As we see, the commodity prices are also started to correct from the peaks. So coal prices are off, crude prices also after hitting a high of 120, it's been down to around $100 levels. Our view on crude is very simple because this is something which is of a significant importance to India. From here on, we see crude heading towards 75 rather than going towards 150. And the reason we feel so is because US is also getting significantly impacted by higher crude prices. There is very likely that they'll remove the sanctions on Iran and Iraq, and there can be additional supply there. Renewable focus is back with the kind of power spike that we have seen in the European nations. Nuclear power is going to be back. Post the Japanese nuclear crisis, there was you can say complete shun towards nuclear energy in the European region, which today now they are realizing that it's not practically possible to completely ignore nuclear power because that's one of the cheapest and the cleanest way to generate energy. And I believe nuclear power also is going to come back sooner than later. And all these factors together, plus the forthcoming shale gas and shale oil from the US, will only ensure that the supply is going to be better. And hence we feel that crude is lower than higher from current level. And this is something which is going to be pretty positive for the markets. Coming to the valuations, post the recent corrections, we are now trading below 10-year average valuation for the market, and it's fairly priced. I would say that we are no longer cheap. We are not a cheap market in a way, but at the same time, we are no longer expensive either. At 16, 17 times 1 year forward earnings, we are decently priced. The earnings growth in India is supposed to be anywhere in high teens, and this is something which bodes well overall for the markets. Also, if you see, over the last few years, the bond market or the debt market yields have crashed. What used to be 8% today is somewhere around 5% pre-tax. In that scenario, where your bond returns have hauled, it is logical for equity multiples to rise, which has happened over the past few years. But post this recent correction, we are now back to below 10-year average, which is something which is very comforting for us. One of the recent worries in the market has been the FI selling that we are seeing. It's rare to see an FI selling figure so huge that for the past 6 to 7 months, every month there has been net selling. But the good thing here is that domestic inflow has been more than what the FI selling has been, and that has been helped to keep the market stable. We expect this trend to continue. At the same time, we expect the FIs to be back. If you see the historic performance of India versus the peer group, which is the peer group emerging markets, across market cycles, across timeframes, Indian equity markets have done better than most of the other markets. And hence, we don't see any reason why the FI money should not come back into India. And also the FI outflow that we see is also because a lot of this money came back as an FDI into the startup scheme of India, or they came into IPOs. And hence, it's not that this money has gone completely out of India. Bulk of that money has also come through other avenues into other subsegments of the market. Overall, as an economy, we have benefited. But going ahead, I think once market stabilizes over the next 3 to 6 months, the FI flows should be back. The domestic liquidities and the domestic flows should continue to be as strong as what we have seen in the recent times. And this is what builds our confidence as to why India is headed towards a decent market return scenario from here on, which is the earnings growth. Anywhere mid-teen kind of earnings growth is what we're expecting the markets to sustain over the coming years, and this is what ultimately will lead to the market return. There are some positives also. Fiscal deficit is in position. We have a decent current account situation as we speak, and hence the currency is stable. We have one of the highest forex reserves that we have seen in the recent decade, and IT services and the pharma exports have been much well over the past few years. And today we have reached a scenario where our IT export earnings is almost similar to what our oil import bill is, and this is something which is very positive overall as a company, as a country, and for the currency. And this is what is something that we are pretty positive about. And this is something which I believe we all know, that economy is back on track post the lockdown. It's been months now where COVID has been under control. It's no longer a point of discussion that we have across businesses, across our social life. If you see most of the high frequency numbers, they all now trending above pre-COVID levels. And the government finances are also doing well. If you see the GST collection also, that's something which we very closely monitor, is also on its high. So overall, the economy seems to be in a good shape. The government has got its act together, not just on the medical front, but even on the economic front. And a combination of these two factors, along with a reasonable valuation, is something that we are pretty excited about. And that fuels our optimism that from here on, equity market should continue to deliver a mid-teen kind of a return over the long term. It's not going to be linear. There are going to be ups and downs. Last 2 years have been great. Maybe this year or the next coming 3 to 6 months, markets can be volatile. They can be flattish, or they can be marginally positive. But over a 3 to 4 year investment horizon, which we feel every investor should be, who is looking at equity market, should have that time frame. Over this time frame, a good double-digit mid-teen kinds of return is easily possible from Indian markets. Some of the points that are fueling our optimism is that unlike last time when the GDP growth was completely consumption driven, this time we have seen revival of manufacturing. Almost half of the Apple and Samsung phones that we use today are now made in India. The Atmanirbhar Bharat, the Make in India program, the government has done well. There have been large capex announcements that are coming from big corporate houses, and the China Plus One strategy is helping us because the export demand is suddenly picking, and it's not just IT and pharma, but we have now new sectors also like textiles, garmenting, tiles, where we are seeing good export demand coming in because of the China Plus One strategy. And it's a combination of these factors which we feel that India is now well placed among the emerging markets. And if you see, look around, our neighbors are in bad shape. Pakistan is in bad shape. Sri Lanka is in bad shape. Argentina, Greece, Brazil, these are all in bad shapes. Russia is no longer a stable country, and so is China. The kind of policy flips of the Chinese market have seen. Investors have lost a good deal of money in the Chinese market, and hence within the emerging market also, India has emerged as a credible market, as a credible economy with a very stable government, and this all bodes well for the equity markets over the long term. So that's broadly the market outlook that we feel. I'll pause here. I will now request my colleague Chetan to come in. He'll take you through the Build India portfolio, the portfolio that we have curated for our RIA investors. The portfolio is a healthy combination of the sectors which are in an upswing, which is the capital goods sector, the infra economy of India, and Chetan will take you through the detail as to why we are excited about this segment of the market and what is our outlook here. Chetan,
yeah, sure.
Can you just join in now?
Yeah, thanks, Aman, for the outlook and for the brief, on the commentary on the economy. I will just start sharing my screen. Just a sec, it's taking some time. Can you view it in a full layout?
Yes, we can, Chetan.
Yeah. So good. Hi, viewers. So I am managing the Build India portfolio over here at Abacus. I am associated with Abacus since inception. It's now 4 years, and I have been given this opportunity to manage and curate the portfolio. Now, what is Build India portfolio? Now, the Build India portfolio is we have identified the companies which are going to get benefited on account of the economic development, the capacity expansion, and the economic reforms which will be benefiting the companies will be coming in our portfolio. Now, what made us positive? Okay, these are the various the broad macro indicators, how they fared in various cycles. So starting from 2003 to 5 and the mid cycle, late cycle. Now, where are we in terms of those the macro indicators? According to our study, starting from the commodity prices and going up to the global outlook, the thing what we are seeing is that the India is in a nicely positioned stage wherein we are seeing that the company we are the companies the capex initiated by the companies and the demand outlook is going to be on an inflection stage, and the companies who are on the manufacturing end will stand to benefit because of it. The inflation, the government spending, it started with the government spending, wherein the government has taken quite a lion's share in terms of overall spending, starting with the roads, railways, on the energy front, and followed by the private capex also, which has started seeing the initial traction now, but it has a long way to go. In our view, the government capex added by the ignited the private capex, we'll see that we are at a very good position in terms of the capex spending, which we saw last in 2003 to 2007. As well as now, what is helping the corporate scenario also is the deleveraged balance sheet. All the companies which were like burdened with the leverage balance sheet and the balance sheet was quite in a shaky stage. Now all the companies have come through that. Even the lenders have been done with the NPA cycle. So everyone are like lean and trim, and are here nicely poised from here on to give the lending to fuel the credit growth, as well as the borrower are also quite confident considering the demand environment. So this is a brief outlook, okay, how the Nifty Infra Index fared vis-a-vis the Nifty 50. Nifty Infra is not a pure, our portfolio is a benchmark agnostic, reason being that we have picked the companies across the sectors, unlike the Nifty Infra, which is quite skewed on the oil and gas and the power sector. But nonetheless, just we wanted to see how the infra index has performed vis-a-vis the Nifty 50 in various cycles. So bearing till 2008, the Nifty infra had outperformed the Nifty 50 by a good margin. But post that, we are not seeing a close resemblance also we are from Nifty infra vis-a-vis the Nifty 50. But going forward, we expect that the order inflow of the companies, as what we are seeing in the from the quarterly result season also, and the commentary by the company, we see that the things have started, the ball has started rolling, and the good things are yet to come. As continuation in why to look at the infra now. Now actually the ball started kicking in when the government announced the demonetization. Though it was a period of the consolidation, then followed by the GST. And the NDA government has got a badge of the pro growth, and they have always preferred the capitalist over the socialist stance. wherein they would not be minding giving the incentives in spurring the manufacturing activity rather than giving the free edge to the economy. So all these factors are adding up all these factors are adding up or to spur the capex growth in the country, sir. Now, this is a chart wherein how much time we took to reach $1 trillion of economy. So if we see as we move ahead, the time period to achieve the $1 trillion to $1 trillion economy is getting shorter and shorter. And now the 4 trillion, we will be hitting the 4 trillion quickly by 2023, 24. And the 5 trillion will not be taking more than 2 years from there. As we saw in 2020, wherein the government came out with a robust, strong outlook on the capex front, wherein the government itself will be doing a capex of nearly about 111 lakhs of crores, vis-a-vis which is actually double from the last 5-year plan. So this capex will be going majorly towards energy, roads, urban, railways. These 4 sectors itself will be constituting nearly about 60-65% of the spending. And this sector will be having a multiplicative effect, wherein the jobs, though they will be generating, but indirect benefit in terms of the ancillary industries which will be supporting those, and vis-a-vis the employment what they would be generating, and finally the consumer, the increasing in the consumer spending. Even on the airports, the government has given laid out a quite a robust roadmap in terms of increasing the number of airports, ports. Basically, we are laying a roadmap wherein all the infrastructure, the bottlenecks will be getting out in place, and will be laying out a roadmap wherein all the logistic issues are getting resolved. So these are the few broad the macro indicators which made us positive in terms of the liquidity in the system is quite at a all-time high. Even on the credit growth fund, all the credit growth which was in last 3 years was driven more broadly by the consumer, the retail sector will be getting sideways, and even now on the corporate credit growth will start taking place, as the banks are also done with the NPA cycle, and on the private capital, on the private inc also, the companies are also now seeing the roadmap has been laid for them, and the balance sheet is clean, so they also would not mind in going out for the capex. Even on the government, on the one hand, they have initiated a strong the capex outlay, but at the same time, how to get the money also. So at the same time, they have rolled out with the national monetization plan also, wherein they have laid out for the FI. If we see the chart from here, for the bottom, right-hand side bottom, wherein the government has initiated that they are targeting nearly about 1 trillion rupees every year, or 1.5 trillion rupees every year in respect to next 3 years. Now, this is quite an interesting chart, wherein the government has not only announced the policies and reforms, but they have done some constructive work, starting with Make in India, and the China +1, which was quite a positive fallout for the country like us. Now everyone are seeing India as a second reliable vendor source. That is one of the things, followed by PLI. Government was quite proactive and fast in expediting process, and getting more and more industry under the PLI scheme. We saw that getting started with the electronics and the mobile industry, followed by the consumer durables, followed by auto, renewables, and many more other sectors. Corporate tax rate, as what they had said earlier, the corporate tax rate has been brought down to 25% across. And now for the company, over and above that, the company going for the manufacturing activity, the corporate tax rate for them has further been reduced down from 25% to 15%. So giving a kick to the corporates to come forward and do the capex in the country. The reforms, the government has initiated quite a many reforms, like from farm bill to land and labor, which are quite a big structural bottleneck. So to expedite the process, the government has come out with many bit of reforms. And nonetheless, the disinvestment, the Air India disinvestment is done. The which was considered to be a dream so far. now that has been a reality. LIC IPO also got done. So the government is quite proactive and taking quite constructive steps in igniting the private capex, and the results what we are seeing are quite encouraging. On this slide, we are seeing that already the amount of investment committed is already 2.4 trillion rupees, and which will further go to 4.4 trillion rupees. And this is across the sectors, as I mentioned earlier, from mobile to pharma to auto to specialty steel to textile, everywhere. On the roads front also, the NHAI awarding has been quite encouraging. Even in the next 3-4 years, the pipeline is quite strong. Nearly about 25,000 kilometers roads are yet to be awarded, and the amount of capex which will be going is nearly about 150 lakh crores every year on the road side. Even the railway front, apart from the electrification work, the DFC work is also going on quite on a full swing. So that also will be seeing quite a big capex being rolled out by the government. Followed by the airports, as what I had mentioned earlier. So there are 8 greenfield projects which will be getting set up over a period of next 3-4 years. Followed by the 50 airports will be getting modernized and refurbished. And now the bottom side, right hand side bottom chart, the data center, which is a upcoming sector, which has started seeing quite a good traction. The industry, which was expected to be $3 billion, will go up to $8 billion in just a span of 3-4 years. Even the core sectors like cement, steel are seeing quite a good times right now. The steels, even in the steel sector, the earnings, the tailwinds what the industry has seen have made them to announce the next level of capacity announcement, which will be getting rolled out in the next 3-4 years. So that also augurs well. Followed by the capex on the oil and the energy front also. The pipeline, which is also quite encouraging, nearly about 3.5 trillion rupees. These if you see the top, the left hand side top chart, wherein the participation of the private, which had gone down to, which was up at 54% in nearly about in 2009, had gone down to 37%. The things have started moving up. Now our premise is that now these contributions should start picking up going forward. Even on the order inflow, all the cap good companies are right now seeing quite a good traction on the order inflow. The commentary, what they are saying, that all these corporates are seeing quite a good traction at the ground level, and bearing the commodity inflation, which is right now all the companies are going through. They have been able to take the price hike, but they are saying that in next one of the situations should get normalized, and the traction what they are seeing is encouraging them to go for the capacity expansion. This is a global outlook. I'm just not dwelling much more time over here. And how we have mapped out the opportunities, how we are trying to take the benefit because of the government capex. So we have on the left hand side, we have just segregated the companies who will be getting benefited because of what. So from government capex, the beneficiaries will be like EPC, heavy industry engineering companies. From the private capex, again the natural fallout will be on the capital goods and engineering companies. Digital infra will be like the beneficiary will be like fintech, e-commerce and OTT sectors. Because of the global capex, the companies which are setting up the capex over here to meet the global requirement, the companies which will be getting benefited like metal, steel and engineering exports companies, and like the spending by the spending led by the liquidity, low interest rate, the beneficiary will be like the corporate lenders. And the ancillaries will be like, which will be getting benefited because of that will be real estate, building products and the support companies. And this is the framework what we have made, wherein how many companies are there basically falling into the various parameters within the from EPC to support companies, and how we are going to take the advantage. Now the key the risk of our portfolio is that it's quite a the rising commodity and the other costs are like a major risk, which could be a big headwind for the corporate profitability and can impact the earnings growth. It's a high beta sector. Basically, that the earnings could be lumpy in the near term. But what we foresee from our next 3 to 5 years, the companies are poised to benefit because of the capex being taken in the country. So we maintain a positive view, but it's quite a high risk, high reward thing. Yeah, these are the normal risk factors. Yeah, I'm done. Pranav.
Sure. So thanks a lot, Chetan. Thanks a lot, Aman, for coming over and sharing your investment philosophy. So before we conclude the session, I thought of posing a couple of questions from my side, which we generally tend to get from investors. So the first question that I have for one or both of you, whoever wants to pick it up, is how are these small cases expected to perform during turbulent market conditions?
See, these are thematic investments, and they are, you can say, segment or a sector focused fund, and hence the near-term performance might not mirror what the market is. So there can be phases where the infra stocks or cap good stocks are higher or lower than what the broad market is, because the broad market is predominantly 30-35% is financials and IT. And this sector has a very low weight in the broad market index. And hence, in the near term, the performance can be materially different from what the market is. But over a period of time, as Chetan explained, the rationale for this portfolio, that we expect earnings growth to accelerate. We expect GDP to do well. The government has got its act together. We are seeing a renewed focus on manufacturing in India. We expect all this to materially get visible into the earnings of these companies, and hence that should be getting reflected in the portfolio. So over a period of time, we expect this portfolio to significantly outperform what the broad market returns are. But in the near term, returns can be different just because the weight in the Nifty or Sensex is very different than the sector weight.
Got it. And we had spoken about how you're using the meets framework to basically shortlist the stocks that need to be added to the basket of the portfolio. So I wanted to understand from my end if you would be changing the philosophy if the broader market conditions start changing or evolving.
Not really, because see, this is a very specific built India portfolio, and hence we would like to be true to the strategy or true to what we intend to do into this fund. So just because tomorrow financial stocks, IT stocks start doing well, we will not get into these sectors. This is going to be a very sector focused, theme focused fund, and we would like to maintain that discipline.
Got it. And one last question that I have for you is, do you plan on launching any new strategies or any new small cases in the future?
Nothing on hand as of now or in the very near term, but we would definitely consider a new strategy. As and when we come up with something, we'll definitely inform you as well as the investors at large.
Sure. So with that said, thanks a lot, Chetan. Thanks a lot, Aman, for coming over to the session today and basically sharing the philosophy behind how Abacus goes about building its small cases and its portfolios. So for the viewers today, you can head over to the Angel Broking platform and take a look at the small cases which have been designed by Abacus. Thanks a lot, everyone, for taking your time out and tuning to this session. So hoping to see you all in a future session shortly. Thanks a lot.
Thank you, Pranav.
Thanks, Pranav.